Hey guys, welcome back to the channel. It's me, Adam. You're watching Steady Invest. In this video, I'm going to be talking about 3 different Chinese stocks that I'm going to be watching if we continue seeing more downside. And a lot of investors are panicking right now because of the potential delisting of these Chinese companies on American stock exchanges. However, when people are fearful and they're panicking, these usually make the best buying opportunities. Unless you catch a falling knife and it keeps dropping, in which case you should have a plan beforehand so you know exactly what you're going to do. Have a plan, do your research. Now, before we get to the video, if you haven't already, smash that like button. It helps my videos get out there. As well, if you're new to the channel, welcome aboard. Hit that subscribe button. As well, if you're in Canada and want to start trading with Wealthsimple or Questrade, use my links below and we'll both get free money. Now let's get started. Alright, number 1 on our list we have Alibaba stock, no surprise here. I actually made a video about Alibaba about a few weeks ago. I'm going to link that in my description below. We can see from the March crash up until a few weeks ago, we were about 70% up. And since that peak about a month ago, we've seen it drop 15% due to regulations from the Chinese government, as well from investor sentiment from the possible delisting. In my last video, I went more in depth, but Shanghai and Hong Kong stock exchanges pulled out of the Ant Group IPO, and it was supposed to be the biggest one to date. And then Jack Ma, the founder of Alibaba, started talking smack about the government and the banking systems, not people you want to mess with. And to me, I just look at Alibaba's financials and I say, how can you not buy this stock? To me personally, it's just the risk of it being a Chinese company. We're seeing 30% year over year total revenue growth, their cloud computing revenue of 60%, and about $6 billion in free cash flow. Their 30% year over year revenue growth was mainly driven by the robust revenue growth of Chinese commerce retail, cloud computing, and logistics services. Alibaba also owns a third of the Ant Group, which is China's largest digital payment platform. And yes, about a month ago, this trimmed $60 billion from Alibaba's market cap. But here's the thing, it's not like Alibaba still doesn't own that 33% stake. Again, in my opinion, I think investors are just down on the stock right now. And considering it's only a $722 billion market cap, and how enormous they are, and how much of China's e-commerce market share they own, the closer to 250, the more of a buyer I'm going to become. Alright, next up we have Tencent Holdings, ticker symbol TCEHY, and the trade on the over-the-counter markets. And this is one of the world's mammoth internet companies. And one of my favorite games that I hate so much is called League of Legends, which is owned by Riot Games, which in turn is owned by Tencent. It has a market cap of $729 billion, and I can't imagine how much that's going to be in 2030. In my opinion, well over $1 trillion, maybe even 1.5. And they actually remind me of Facebook a little bit. They just own so many different products used by people all over the world. One of their biggest products, Wechat, is absolutely massive in China. It's not just an instant messaging platform, it can also be used for media, for making payments, and so much more. And it integrates with the entire Tencent system. Over 1.2 billion combined monthly active user accounts in the third quarter. And that's the nature of China when you have so many people and you have such a big market share. And they just have so many different services. And the list goes on and on and on. Again, League of Legends, NBA 2K, FIFA. And I'm still scrolling. There's just so much. And you can see with their ecosystem, they're trying to put it all together. And see this big cog over here? That's Wechat. And see how it connects to all the other different platforms. And they're strengthening their ecosystem through investments. They're an absolute internet monster. And the thing is, I still think they're reasonably valued even at $700 billion. They're a giant that keeps on growing. And this is following the worldwide trend of digitalization. Their online games, their online advertising, and their fintech businesses are all growing. Tencent's online gaming revenue surged 45% year over year, marking an acceleration from its 40% growth in the second quarter and accounted for a third of its top line. And this is something else I like. Tencent's online ad business, which scatters ads all across its sprawling ecosystem. So they show these ads within their ecosystem, continues to outperform the broader industry. Rising 16% year over year, accelerating from its 13% growth in the second quarter and accounted for 17% of its top line. Tencent's fintech and business services revenue, which mainly come from Tenpay, Wechat Pay, its various fintech services, and Tencent Cloud, rose 24% year over year and accounted for 27% of its top line. Though this is a slowdown from the 30% growth we did see in the second quarter. As well, Tencent is the big gaming winner as Huya and Douyu agreed to merge. And why is this important? Huya is China's most popular online gaming site, while Douyu is number 2, Together, they control 80% of the Chinese market, as they will have nearly a 68% stake in the new company that is created. That leads me to stock number 3, Huya, ticker symbol HUYA on the New York Stock Exchange. It's currently trading at a $4.58 billion market cap, and I think this is currently undervalued for what's about to come. It's been a rocky road ever since the IPO. We saw it crash to $13 back in March. We saw it as high as $30 back in September. And now we're trading about 33% less at about $19.30. And this is a stock, the lower it goes, the more attractive it's becoming. So back in June, I saw this article, Tencent up stake in Chinese loss-making EV maker NIO. And I knew at the time how big Tencent was, and I'm like, oh, NIO. And at this time, NIO was trading for $7. And at the time, I actually started a position with NIO, but it wasn't really going anywhere, so then I sold out. What a mistake that was. So I'm trying to learn from that last mistake. If Tencent believes in a company, I'm going to look into it. So back when the deal was made back in October, it was supposed to create a company with a market value of just over $11 billion. Over the past quarter, DouYu reached an MAU of 194 million with an increase of 18.6% year on year, while Huya's MAU reached 173 million year over year. The paying users of DouYu and Huya rose to 7.9 million and 6 million respectively, representing an increase of 12.7% and 13.2%. Looking at Huya's total net revenues for the third quarter, they increased by 24.3% to $414 million. Gross profit increased by 52.7% to $91 million, as well as gross margin increasing to 22% from 17.9% for the same period last year. And they've also gone internationally to Brazil, creating Nemo TV, which is the country's leading mobile streaming platform. Huya generates most of its revenue from its live streaming platform, which allows users to give gifts and donations to their favorite streamers. And it's actually a free platform. You could actually check the website right now. But here's the thing, like Twitch, Huya is actually free for people to watch, but people are choosing to pay money. And if your product is getting people to willingly spend, as well the streamers want to make more money, so the better they do, the better Huya does. It reported its first annual profit of $67.2 million in 2019 thanks to expanding margins. These numbers indicate that Huya is capable of growing quickly and profitably. The latter also validates the potential behind the company's business model, again, which depends mainly on income from selling virtual goods. Now hear this, as Huya continues to grow its business, it could leverage its economies of scale to improve its margins. In other words, it could also advance net profit at a faster pace than revenue in the future. According to research, China's esports industry could reach 537 million gamers by 2022. That growth benefits the video game streaming market in China, which is projected to grow from 1.2 billion in 2017 to 4.9 billion in 2022 at a compound annual growth rate of 34%, and Huya is one of the biggest players in the space with an estimated market share around 30 to 40%. Again, that's before the merger. And this is awesome too. I'm going to show you guys in a second. Internally, Huya is investing significant resources to grow the quantity and quality of its content offerings. For example, the company has expanded into the non-game entertainment content, such as talent shows, anime, outdoor activities, live chats, and more. By diversifying its content, Huya can appeal to new users while improving the engagement level of its existing viewers. And that's such a smart idea. So a growing user base, which attracts new people to make new content, high quality content, and this just creates exponential growth. Huya can then improve its monetization by growing the total number of paying users, which stood at 6.2 million, or 3.6% of total monthly active users in the latest quarter. There's also eQuiqui, I hope I'm pronouncing that correctly, which is another really well-known video platform, but it's more so for TV shows and movies, and they're actually a subsidiary of Baidu. But looking at revenue growth, it isn't even close. One's profitable and one's not. And we can see this on their website. They just have a live chat going on over here. Backed by Tencent, I can see this growing more and more and more. And you can see over here the amount of people that are donating. And putting it all together in Tencent's ecosystem, they can advertise for free someone playing League of Legends, which is their game, on their own mobile platform. And they'll have that real estate as the biggest gaming platform in China. Again, a lot of room for growth in a growing market, but it doesn't come without its risks, of course. It's a newer, smaller company based out of China. But as always, risk correlates with reward. So it'll be interesting to see how this all plays out and investor sentiment over the upcoming weeks. Me personally, I'm hoping for lower prices. I like when stocks are on sale, but the market is always unpredictable. If you can find a quality company that's been beaten down at the right time, it could pay off huge in the long term. And that's it for my video. Thank you very much for watching. As always, smash that like button, hit that subscribe button for future updates, and I'll see you guys in the next video.